What's up, guys? Eric here. Big night of earnings, big cap tech. We've got a couple earnings reports out tonight. I'm going to specifically focus on Amazon. This is one of my largest holdings. I've been long on it for many years, and I know the company very well. Now, one thing I explained to the Discord community, I said last night we did a podcast, and I said, hey, if other big cap names struggled this quarter, what do you think might happen to a company like Amazon, who has a tremendous amount of inventory, labor, warehouses, supply chain issues, millions of SKUs that they sell? And that's what we're seeing here. So Amazon stock at one point was down over 21%. I think maybe even a little bit more than that. A lot of this comes down to guidance. It was a miss. There's also some confusion again about earnings per share and some of those write-offs. So it gave disappointing sales forecasts in the fourth quarter. Stock sunk in extended trading. Right now, it's down $19.56. It's hovering around $90 a share. It was in the 80s at one point. So the earnings were 28 cents a share. Revenue was $127.1 billion versus $127.46 billion expected. Amazon Web Services, this is the big one. I want to spend a minute talking about this. So AWS, you think of cloud, we had a couple of the other big vendors report. You think of Azure, GCP, and one was a little bit higher, one was a little bit light. So the question was, what's going to happen? Maybe AWS actually beat their number, and it shows that cloud is still accelerating. Now, cloud is still growing. And one thing you have to keep in mind, there's going to be $1 trillion of cloud spend over the next 4 and 5 years. Now, it's not a matter of if that happens, it's a matter of when. So people are going to go to cloud. That is the future, and we're going to see that growth. And you've got the big three really in the US that are going to capture that when you think of the public cloud. Now, with that said, executives, especially in this type of environment with inflation, with uncertainty, there's going to be a tightening of purse strings. And so you might delay projects, and that's what you're seeing here. So Amazon Web Services talking about a $600 million miss on cloud. But now we saw stocks like ServiceNow report yesterday, and they blew their number out of the water. So all eyes on companies like CrowdStrike and Datadog as they report earnings to see how those software as a service vendors are performing under cloud versus the cloud services segment, okay? That'll be interesting to see, but it's not unlikely for someone to say, hey, you might see some tightening of purse strings, you might see some delay in projects. There's three things that happen anytime you have a bear market like this. The market goes first, then the earnings, then the economy. Now, this is really gonna come down to the Fed. And a lot of people are saying that the Fed's gonna pivot. Of course, as the Fed pivots, you're gonna see a huge rally, but most people would agree that's not the case, that the Fed's laser focused on inflation. So this is all going to come down to CPI data, what the Fed does for interest rate hikes, how hawkish or dovish they are. Earnings certainly matter, but they are starting to deteriorate, and we've seen that from some of the largest companies in the world over the past several days. So here's where Amazon really got hit bad. This is where the knee-jerk reaction, where this, the sell-off just intensified when it said that it expects to post fourth quarter revenue between 140 and 148 billion. Okay, this represents year-over-year growth of 2% to 8%. Now, before the sell-off, Amazon was 100 P ratio. In this type of a market, the valuation matters in this type of a market. Okay, so when you think of some of these other stocks that pay dividends that are trading at 24 P ratio, like the other one that just reported tonight, this one doesn't have a dividend and it still has a high P ratio. Even after selling off, it still has a 90 P ratio or something like that. But this is the big deal here, guys. This is weak guidance. So not only did they miss, advertising was actually up. That was a bright spot. So what's interesting to see here is that advertising for Amazon was actually up. Most people are missing on advertising. So it's a little bit unique how they advertise, and that part of the business is very healthy. Amazon Web Services, I have no concern longer term, but again, there might be some projects that are delayed. But this is the big miss here, the guidance. You're looking at 2 to 8% growth. People in Wall Street, they don't want to pay a 90 P ratio for 2 to 8% growth. Now, long term, I think Amazon will be okay, and we'll talk about more of that here later in the video, so stay tuned. I'm also going to show you a chart, show you where I think the stock might go. But analysts were expecting 155.15 billion, and they're projecting 140 to 148 billion. That's a significant miss. And that's the main driver of why the stock, fell off a cliff. I've been saying I like it closer to 100, especially if it goes on to $100, 105 or less, try to get it close to 100. A lot of times that psychological number is 100. We did chart day on Wednesday and I said, hey, any of these stocks that we're talking about, The chart doesn't tell me anything, because if earnings miss, it's going to sell off 10, 15, 20, 30% on these names. And here we are. And nothing's immune. It doesn't matter if it's a mega cap tech stock, it can sell off. You saw, Meta sell off under $100, and now Amazon's doing the same thing. A lot of new 52-week lows on these mega cap tech stocks. I think it's a good thing. The reason I think it's a good thing is that mega cap tech needs to have a purge for Wall Street really to say, okay, now we can reset. Now, I'm not saying that reset's going to happen tomorrow, but at some point that had to happen before the market could recover on the other side. So now we're seeing these big names flush out. Overall, it is healthy, even though it might seem scary or painful in the short term. Revenue grew 15% in the third quarter. Okay, so that's double-digit sales expansion. So there are some positives here. It's not like it's a terrible earnings. And you got to remember, $127 billion in revenue is still a lot of money, even though it is a slight miss. So Amazon's advertising business was one bright spot, bucking the trend of digital ad peers, okay, especially like Snapchat and some of these other names, whose ad business have gotten whacked, and those companies sold off really hard. Ad revenue surged 25% year over year, and that was $9.55 billion versus $9.48 billion expected, which is very, very solid. There's a quote here from the CEO, Andy Jassy, and he says, there's obviously a lot of happening in the macroeconomic environment, Jassy said in the press release, and we'll be balancing our investments to be more streamlined without compromising our key long-term strategic bets. One thing you have to remember too, we've talked about this a lot in the private community, when you think of the high dollar, that is going to impact multinationals. So companies like Amazon are certainly impacted by that dollar and those conversion rates, so definitely keep that in mind as well. So it's not like this is just rolling over and everything's bad. It's just the market doesn't want to pay a 100 P ratio when they're not crushing their numbers and they're not growing at extreme rates. There has to be growth there to justify the valuation, especially in a bear market. This is another big deal though. Free cash flow decreased to an outflow of $19.7 billion. That's compared to an inflow of $2.6 billion for trailing 12 months, 2021 September. There are some positives here. Amazon Prime, they've got the series like Lord of the Rings. They're doing the Thursday Night Football for NFL. It talks about a lot of this. So definitely positives. When I think about this company longer term, I think the company will do fine longer term. It's just in this environment, again, no one's going to want to pay for the valuation. Let's look at a chart. I'll tell you where I think Amazon stock might go. So up next, guys, I'm going to show you a chart of Amazon, give you some final thoughts about the company and the stock longer term, and I'm going to look at a chart and show you where it might go, where it's at right now. Now, before I do that, I need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/fired up wealth. And a reminder, Motley Fool doesn't tell me what to make, what to create. They're a great partner. They allow me to create content for free on YouTube for you to consume like this here. So check those guys out. We also have a private community. You can check out patreon.com/fired up wealth. You can join us in Discord. We also have tons of videos and podcasts that are private and that are not part of the YouTube community. So let's look at a chart of Amazon. It's actually recovered a little bit since earlier. It's actually down to 92.21. At one point here, if I look at this chart, if I look at the after hours chart on Amazon, at one point, guys, this thing got down all the way here to 88 bucks. And now it's back, trading in the $92 range. This was a 99P ratio at $110, so you can do the quick math there. Market cap 1.13 trillion. It's kind of taking it down to that $1 trillion line. It's probably going to try to hover or hold that $1 trillion market cap area, which is very interesting. So if you look at this, all the supports have now broken. It's really hard to know exactly where this might bottom out. I think if you're dollar cost averaging, I said I like it closer to $100. So if say you bought some at 100, 105, this is why you dollar cost average. You buy in lots and you buy levels. And so you'd be able to add some more here and you try to, strengthen that cost basis. Now, the thing about this stock and this company is it's probably not going to be unicorns and rainbows from this point out. Generally, you're going to see a strong earnings report the next earnings. So when they report again, you're going to have the holiday season in there. Now, if you listen to the earnings call, it talks about how that might be weaker than expected. And so you might not have great earnings. I think that the next earnings, 3 months from now, I think they're going to report much stronger earnings, but I could be wrong. I could be wrong because the economy is still weakening, maybe we go into recession, and this certainly could go lower. If I look at this longer term and I'm trying to look at it neutrally and say, what's this thing worth? Well, is it worth a 90P ratio when it's growing at that? If I'm a money manager, I might say no. And so I might sell it and you might see more pressure. Maybe this thing goes lower. It could bottom at $90 or $88 where it was, or I could see it at $75 at some point. There's no way to really know. And when I look at a chart here, it's broken through everything. This support line here is 98 bucks. So maybe buyers come in, especially if the earnings call is good, if there's some positivity, but it's really hard to know. I wish I had a crystal ball to tell you it's going to bottom at this exact price and this date, but I don't know. And so data is going to matter. CPI data, if the Fed pivots tomorrow, all these stocks are going to race higher. The Fed keeps tightening, we go into recession, everything is going to go lower. You're probably going to see lower lows in the market. I tell the community, the private community, I say expect lower lows. If it doesn't happen, it's a bonus. Do I think long-term Amazon's attractive at $90 a share? The answer is yes, but you have to have the proper time horizon, 5+ years, knowing that if you're buying at that level, it certainly could go lower. I hope this was helpful. If you're new to the channel, subscribe, click that bell to get notifications, drop me a like, drop me a comment. Have a great rest of your day. Take care.